A single price can reveal an entire system, not a billion-dollar merger, not a market crash, just $65. When Caroline Kennedy approved a modest federal fee decision tied to cultural access and public assets, financial elites barely noticed at first, but inside policy circles, the signal was unmistakable. Value, ownership, and public wealth were being reframed. To understand why such a small number could unsettle billionaires, we have to step back. Because throughout history, power has often turned on who decides the price of access, not only to land or labor, but to national inheritance itself. In modern economies, wealth is not only created through production, it is also created through control of assets. Real estate, intellectual property, natural resources, and cultural institutions. These assets often originate in public domain. They belong to societies before markets monetize them, and their pricing determines who benefits from them. Historically, ruling classes converted shared resources into private wealth. Enclosures in early modern Europe transformed communal land into estates. Colonial concessions transferred resource rights to chartered companies. In each case, access shifted from collective to priced. The gatekeeper changed, and with it, the distribution of wealth. The United States followed similar patterns. Public lands were granted, sold, or leased. Infrastructure and cultural capital developed under state support. Over time, private actors captured increasing returns. Museums, archives, urban land, and symbolic heritage gained market value. Access often became stratified by income. Policy decisions about fees, rights, or pricing therefore carry deep implications. They define whether public assets remain broadly shared, or whether they function as revenue streams for concentrated capital. The $65 decision sits within this long arc. At face value, it concerned administrative cost recovery tied to federally stewarded cultural or intellectual property access, a routine adjustment in bureaucratic terms. Yet the symbolism cut deeper. It asserted that national heritage carries measurable value, and that access pricing can be publicly determined rather than privately extracted. For financial elites accustomed to market-based monetization, this mattered. Cultural capital has become an investment class. Licensing, branding, and heritage experiences generate returns. Global wealth increasingly flows into intangible assets. Names, archives, creative works, and historical associations hold premium value. They shape tourism, media, and prestige markets. When a state representative prices access modestly, it signals restraint. It suggests public stewardship rather than profit maximization. And that principle challenges certain financial expectations. Throughout financial history, elites have sought to expand monetizable domains. Land became rent. Knowledge became intellectual property. Culture itself became commodified. Museums charge entry. Historic symbols become licensed brands. This process reflects capital's search for yield. As traditional returns fluctuate, investors seek new asset classes. Heritage and identity become economic territory. The decision therefore intersected with broader debates. Should national cultural resources function as profit centers or remain low-cost public goods? $65 is modest. That is precisely the point. It draws a boundary against aggressive monetization. In historical perspective, such boundaries matter. They determine whether societies experience enclosure or access, whether commons persist or vanish. Consider how states historically managed religious or cultural institutions. Temples, shrines, and civic monuments often remain publicly supported. Their legitimacy derived from shared identity. When privatized or heavily priced, legitimacy shifted. Access narrowed. Authority became transactional. Modern democracies face similar tensions. Public assets require funding, but pricing shapes inclusion. Financial elites often advocate market valuation. It maximizes revenue and signals scarcity, yet it can also concentrate benefit. Public interest pricing prioritizes accessibility. It limits profit extraction, and it preserves collective ownership. The $65 figure thus embodies a philosophy. Public wealth should not be fully financialized. Some value should remain civic. For billionaires operating within global asset markets, this signals friction. It suggests domains resistant to capitalization, and that constrains opportunity. Historically, such resistance has been episodic. Regulations, cultural protections, and public trusts limit privatization. They preserve spheres outside pure market logic. National parks, public archives, and heritage protections follow this tradition. They assert that certain assets transcend profit. They belong to citizens equally. When prominent figures reinforce that principle, markets notice. It implies policy continuity and limits future monetization pathways. The reaction among wealth circles therefore reflects anticipation, not fear of $65, but concern over precedent. If public cultural capital remains lightly priced, private intermediaries cannot capture large rents. If access remains broad, exclusivity premiums shrink. Financial models adjust downward. This dynamic parallels earlier historical episodes. When states regulated land rents, aristocratic income fell. When intellectual property terms shortened, publishers lost leverage. Each time, pricing authority determined wealth distribution. Public control diluted private concentration. Markets resisted. The current era sees intensified financialization. Everything from data to identity becomes monetizable. Cultural heritage is no exception. Brand licensing, digital archives, and experiential tourism create revenue streams. Investors seek partnerships with custodians of history. Returns depend on scarcity and price. A low, publicly set fee counters that logic. It preserves openness. It reduces extractive margin. Thus, a seemingly minor decision resonates structurally. It signals that some assets remain civic goods, and that states may defend that status. From a financial history lens, this echoes older debates. Who owns the past, and who profits from it? Empires often appropriated cultural symbols. They displayed conquered artifacts as prestige capital. Ownership reinforced dominance. Modern nations grapple with stewardship rather than conquest. But economic stakes persist. Cultural capital influences soft power and revenue. Maintaining affordable access sustains legitimacy. It affirms collective identity. It resists commodification excess. For billionaires accustomed to asset expansion, this boundary matters. It delineates non-financialized space and reminds markets of political authority. The episode, therefore, illustrates a recurring pattern. Pricing decisions encode power. They determine inclusion and profit. From medieval guild rights to modern intellectual property, control over access generates wealth. When states intervene, distribution shifts. Economic actors respond. Today's global economy faces widening inequality. Debates intensify over public goods versus private gain. Cultural assets sit within that debate. The $65 decision becomes symbolic in this context. It affirms that not all value should scale to market extremes. Some remain socially defined. Such signals influence expectations. Investors read policy direction. They adjust strategies. Financial history shows that expectations shape markets as much as numbers. A boundary asserted early can redirect capital flows and preserve civic domains. Ultimately, the reaction reveals sensitivity to governance. Elites track where states assert ownership, because ownership frames opportunity. The story is therefore not about cost. It is about authority over valuation. Who decides what heritage is worth? That question has shaped economies for centuries, from land enclosures to intellectual property regimes. Pricing determines power. When public stewards set modest fees, they reclaim that authority. They anchor value in citizenship rather than scarcity, and that recalibrates wealth potential. In a world where almost everything trends toward monetization, restraint stands out. It signals limits to financialization and continuity of public trust. That is why a small number could ripple through elite conversations. It hinted at protected commons. And markets rarely ignore boundaries. Financial systems evolve, but tensions persist. Public versus private, access versus rent. The first dead empires priced obligation to extract surplus. Modern societies price assets to allocate benefit. Both reflect power over value. Understanding these dynamics clarifies why pricing matters. Even modest fees carry ideological weight. They map ownership. In the end, $65 is a marker, a line between civic heritage and commercial asset, and a reminder that value is political. Subscribe to Fiscal Empire Historian for clear financial history behind today's world events.